but we're kicking off right now with Shane Oliver and, of course, Michael McCarthy. Without any further ado, they join me at the desk, guys. Great to see you.
Great, Peter.
Hello, Peter.
Great to be here.
All right, now, I really wanted to have an economist and a markets guy because this is a really interesting budget. Our stock market has had a nice run since February 10. There's some really challenging issues like the deflation number yesterday. On your beat, sell in May and go away often is the and I think actually this week Jeff Wilson actually made the point. He said, my dear old dad always said sell in May and go away. Of course, Jeff is just trying to influence the market as he always does.
He's short, is he?
But he did talk about Pacific Brands, so he got that one right. But it's a really challenging budget because it's pre-election. Let's start off with the question that a lot of commentators throw around, and that is the difficulty around our deficit. How bad is our deficit situation?
Well, when you and I were earlier in our careers...
When I had hair like you.
Well, yeah.
Don't go any further. That's my joke. Go on.
We will all remember 1986 when we had the downgrade.
Yeah.
And it took a long time to get that back. But the odd thing is that we're now having a longer run of budget deficits than we had in the early 1990s, which was in the midst of that downgrading period.
Yeah.
So I can't remember the precise numbers, something like 8 years back then. Looks like we're going out to 13 years, 13 or 14 years this time around. So that's how bad it is. Now, the problem is that we've had this run of budget deficits, both bigger, more years and bigger as share of GDP without having a recession. Back then we had a good reason. We had a recession. This time around we're not. So I think it is a problem. Is it catastrophic? No, it's not. Compared to many other countries, it's hardly anything as a share of GDP.
That's the point. Compared to other countries, we are the best house in the crappiest street, aren't we?
Well, there are some better ones. Norway is...
Oh, forget them.
Are they the lights out?
Sorry, Norwegians.
Well, they are. Yeah. The problem Australia has is that our public debt is, what, 35% of GDP, 35% of GDP?
Yeah.
Not that great compared to Europe, the US, around 100% of GDP, and, of course, Japan around 250% of GDP.
Yeah.
So on that basis, it's not too bad. But the only problem is that we are a country that relies on foreign capital to keep going. We have a current account deficit. That means we're relying on foreign capital to come into the country and finance us. Whereas the Europe is a surplus country, so is Japan. Now, of course, US isn't, but it can print its own money. It's a reserve currency, so it can get away with it. So there is a bit of an issue there if the rest of the world turns against us. Now, so far they haven't. The problem is that this is going to be about the fourth or fifth budget where every time we get to the budget update, it looks worse than it did last time. And that's why the ratings agencies are getting kind of a bit more, starting to lose patience with us.
OK. Is the market worried about our deficit situation?
Yes, they definitely are. It's the structural aspect that really concerns the market overall. It's that potential to have an impact in the long term on our creditworthiness that really concerns the market. So there's certainly a sense that we need to see some action on the structure of this deficit. The market is worried that the expenditures are ever ratcheting up and the revenue is highly variable, and that makes us very vulnerable in a downturn situation. And it's that concern that we'll see a further deterioration globally and that the impact will be multiplied by that structural deficit.
Our fiscal situation, do you think it affects the stock market generally?
I don't think it has significantly. Obviously, when there's a tightening or a tax cut, all those things can impact individual parts of the market. But I think of the last few budgets, in the great scheme of things, the budget was delivered, the market sort of, this brief reaction, and the market goes to worry about other things. Now, I think there probably was some impact around 2014, perhaps, because it did affect confidence in the economy around that time. But overall, it hasn't been that significant. I think if you go into a situation where the market, where the ratings agencies say, well, you haven't got this thing under control, it's out of control, the structural budget deficit's getting worse and worse. And don't forget, it's a bit easier at the moment, but by the time we get to next decade, the impact of the ageing population will really start to impact on the budget. So whichever way you cut it, it will then start getting worse again because of that impact. So I think if you get to that point, then the market, then there could really be a market impact from the budget.
If our AAA rating was taken away, would the stock market sell off pretty substantially?
Yes, the banks would have to sell off on the back of that. You can't have a higher rating for a company than you can for your country, and so they'd all effectively be downgraded. And given that they make up almost half of the market now, hit our market.
How dangerous is that AAA rating?
Well, I think there is a risk there. I think they are losing patience there because, as I said, every time we get a budget update, the numbers are worse than the previous time. Now, this budget, interestingly, might be the one that holds the line for the first time in years, simply because the iron ore price is, what, $62 a tonne. The assumption in the mid-year review last December was $39 a tonne. So that should...
It's a $7 billion benefit.
Yeah, that's a huge benefit. So that should help us to some degree, at least hold the line this time around. The question is to what degree the ratings agencies say, well, you've only done that because you've been delivered a bit of luck because of a higher iron ore price as opposed to structural reform.
All right. The growth number that the Treasurer goes for, our last one was 3%. What number do you think he should be using in the budget?
Well, the focus here will be for 2016-17. I mean, they may be tempted to use something like 3%. I'd probably prefer if they go for a more conservative...
Don't say 2.75.
Well, 2.5 is probably a bit too low, but 2.75...
I knew you'd say that.
Well, OK. Well, you've only got a few numbers that you can choose from. I'm not going to say a negative number. I'm not going to say 4%. You've only got a little range to choose from. It's hard to get so excited.
You've an attitude to the television program. Now you become so comfortable. But fair enough. 2.75 is probably a fair figure. If they go 3 or even higher, because the Reserve Bank's got more optimistic numbers out there for 16, 17, haven't they? They're in the threes.
I think they've got it going up to 3. They both had it going up to 3. So they had a sort of couple of years there with 2.5 and then going up to 3.
Okay. So do you guys actually look at the number and say, we don't believe that number's not right?
Oh, it's very important. Credibility of the estimates is very important. So if we saw an iron ore price of $80 a tonne or we saw an estimate at 4% for growth, then absolutely we'd be concerned. I think that's very unlikely. But I would point out that the lead up to this budget has been very different to our recent experience. Back in the day, all the traders and dealers would stay around after work and we'd all wait till 7:30. We'd all go back to our dealing rooms. I won't say we're at the pub, but we might have been. And then we'd wait for we would sit there and we would listen to the Treasurer, read the budget speech and react. And the markets would open for it and we'd trade on the back of it. Yeah. We don't do that anymore. And one of the reasons for that is in recent years, their practice has been to telegraph most of the major measures in the budget beforehand. That hasn't happened this year. We haven't heard anything. We've heard what's been ruled out. We haven't heard anything about what's going to be in. So expectations have been managed very well here. There's no information out there and they've been managed to a very low point. I don't think anybody's expecting much at all.
Yeah, I guess they don't want to give the opposition any breaks because the election campaign starts on officially.
There's two challenges in this budget. The first one is, as you put it, making sure that it doesn't deteriorate any further, keeping the ratings agencies on side, keeping the rating. The other one is this is an election budget. Now, of course, this happens every third budget. It's an election budget, but it's different this time around because the election is likely to be only a month or so, 6 weeks later. And so that's the big difference. So it's going to be the last major economic statement prior to the election. And of course, when you're going to election, you don't want to slash spending. You don't want to raise taxes aggressively. So what the government will try and do is position itself somewhat different to the opposition. They're going to say, well, we don't want to raise taxes, so there won't be hikes in negative gearing. Capital gains tax will stay as it is, all those sorts of things. But by the same token, they'll try and keep a lid on spending measures. So I think there will be some spending measures, but they'll have to be offset by savings.
But we're going to need some positive spending initiatives around infrastructure, aren't we? Because will the debt rating agencies say, well, that increase in the structural deficit improves productivity going down the track, we can buy that, as opposed to giving away grants to
well, perhaps.
I don't know people because I get called a bit discriminating. You can't discriminate against anyone.
I mean, there is some logic in that. The government can borrow very cheaply at 2.5%, invest in infrastructure, which would surely have a return way above that. And there is a need for infrastructure in Australia. The problem is that we don't actually separate the two out. It's all thrown in together. Infrastructure, capital spending is thrown in.
But the debt rating agencies they should be able to disaggregate it, to work out whether this is dumb spending or it's smart spending.
Well, they should be able to, but
debatable. Well, the market will certainly focus on the quality of any projected deficit as much as anything else. So yes, that's exactly what the market will be looking for.
And let's face it, debt ratings agencies haven't made mistakes in the past, have they?
No. Never.
Don't mention the GFC around one of those.
Yeah, the only reason
Nincompoops.
you can't ignore them totally is that they can have an impact.
Yeah, I agree.
And I think
That's why I'm asking
there could be an
questions.
impact on the banks, as we agreed before.
Yeah.
And I think it's also symbolic. You know, in 1986, when we lost our credit rating from AAA to AA+, September 86, that was a blow to the national psyche.
Yeah.
And we spent the next, 16 years trying to get it back again. Took to 2002 to get it back again, and a Herculean effort to get spending under control, to get the budget into shape. 2 efforts by Keating, and then, of course, a bit later on by Howard and Costello.
Yep.
And then economic reform through the economy. So to suddenly lose it again would be, the implication would be we become a bit of a dumb country, like all those fruitcakes over there in Europe.
Yeah, if we lose it...
Well, some of the fruitcakes in Europe.
Yeah, you just
Not all of them.
Someone heard that.
They're all that way.
Look, I totally agree with most of your sentiment, but the bottom line is, considering that the fruitcake countries out there, they should cut us a lot of slack, I think. But anyway, I'm biased. I'm a very biased Australian. All right, deflation. That number. A, were you surprised? How bad is it?
Of course I was surprised. I was going for, 0.2, 0.3, and it was
you were never
minus
wrong.
0.2. I was wrong.
You're never wrong. That's extraordinary.
Well, you can.
Anyway,
but
my
anyway,
show.
You've got to don't get too excited about deflation here. This was driven by a 10% fall in the petrol price.
Yes.
And something like
11% from fruit prices.
11% from fruit prices. So those two things knocked 0.4% off inflation. So were it not for that, we would have had inflation at 0.2%. But that's still a low number. The real surprise in the inflation figures yesterday was the broad-based weakness in price gains in the economy. So it wasn't just fruit and petrol. There was a whole bunch of other things which were very weak as well. And that, I think, is why the Reserve Bank should be concerned. If you want to cut to the details or the technicalities, the underlying measure of inflation
was up, wasn't it, still?
Yeah, it was up, but only by 0.1, 0.2. I think the average was 0.15%.
Okay.
On an annual basis, it was 1.5, 1.6%, which was the lowest on record.
Yeah. Will they cut on Tuesday?
Well, I think they will.
I think they should, and you think
I think they should, and I think they will. Now, mind you, you and I have had a difference here. I've been thinking they should cut for a while now, and I have been wrong. I had given up on a move for Tuesday because of the good jobs numbers we got a few weeks back. It was fair enough, and also GDP growth 3% and so on. But and they were reasonable reasons for not cutting. And the trouble is that this number is well below the target. And there is a danger that if you leave inflation either too high for too long or too low for too long relative to the target, that inflationary expectations adjust, wages growth suddenly slows down even further, and you start entrenching very low inflation or potentially deflation. So that's why I think it's important for the Reserve Bank to move early.
Okay,
rather than wait till June or July or whenever.
But the markets didn't get spooked by it. Why didn't they get spooked by that?
Well, they kind of did, but they didn't react in the way you might expect. So, first of all, we saw interest rate expectations change immediately. The potential for rate cut went from 15% to 48% in a matter of seconds after this number dropped. So, clearly, interest rate markets were very focused on it. The Aussie fell. That makes sense. It's more likely we'll see rate cuts, and so the Aussie weakened. But the Australian market initially lifted on the basis of an easier interest rate environment and then reversed badly. And I think what happened was those international sellers who are heavy on our banks saw a change in perception of where the currency was going. And once they took the view that the currency was more likely to fall than rise, they took the opportunity to start selling in the market. So we actually were hit hard because of that changed perception around the currency.
So why the rebound today?
Rebound today, we saw a focus shift to Japan in particular in our region. That took some of the weight off. We saw a very different day today. Yesterday there was very much top-down selling. Today was all about individual stocks. So we're looking at a patchwork quilt when we looked at the market map. Green and red all over the place rather than a clear theme when we see it all red or all green screen. So different day.
Why wouldn't the Reserve Bank say, well, look, let's give Scott his day, and if it's no good, we'll cut next month?
Well, he could do that. The trouble is next month you probably will be in the midst... Sorry, June. That'd be the June one.
Oh, yeah,
you will be in the midst of an election campaign.
Glenn Stevens has raised rates for John Howard. There's no reason why he can't cut.
Yeah, that's true, but I kind of think if you're of a mind to cut, then you might as well just get it over with rather than wait. Don't forget, this is a central bank that's been saying that the low inflation numbers give them scope to cut if need be for some time now. So they're already of a mind to cut.
And they'd like the dollar to come down.
And they'd like the dollar to come down. So there are reasons to do it now rather than wait.
Okay, this is Switzer thinking outside the square, which is something I don't often do. But to try and... I was joking then, I do.
We agreed.
Yeah. Well, look, this is a crazy world we're living in. You know, deflation in the old days, we would have thought, OK, demand's struggling. But we've got, you know, I know my wife and a lot of my friends' wives are buying stuff overseas from Net-a-Porter and groups like that. Prices are going down as a consequence. We've got Uber, you know, reducing transport costs. We've got Airbnb bringing down hospitality costs. Everywhere you go, everything is becoming cheaper. There's no pricing power and there's no wage power for anybody. So some of this deflation is because we are living in a world that when I taught people like you economics and when you started learning economics, it was a very different world. Deflation meant aggregate demand is struggling. It's not quite sure, is it, given the fact we saw growth pretty good and employment pretty good.
Totally agree. That's a huge factor there. Technological innovation, you get, I mean, all the things you've got on the computer, I mean, these things have the power that a room of computers had a few years ago, or a few decades ago. So that is deflationary on its own, and that's good deflation. So maybe we're understating real economic growth. The flip side, though, is that there is a lot of spare capacity globally, that we are flooded with manufacturing goods, we're flooded with steel, we're flooded with cars, and that's keeping downwards pressure on prices. So you don't quite know what the mix is. But the problem for the Reserve Bank is that they have a stated inflation target of 2 to 3%, and they're meant to be within that over the course of a business cycle. So you can sort of be a little above for a while.
But they never even believed they'd below 2. 2 was like a reasonable starting point.
Yeah, they thought this would never happen. So I think there is a danger if they let it stay down here for too long. So it's about managing inflation expectations as much as anything else.
Macca, will they cut on Tuesday? No.
And I think that the Reserve Bank has expressed reluctance to cut, and I think the unspoken reason for that is they want something up their sleeve should the situation turn very dire. And although, as they've stated many times, these low inflation reads give them the opportunity, I think the jobs will be enough to stay their hand this time around. They have proven themselves to be apolitical in the past, but there is a reason to take a political view of next Tuesday's decision. One of the key factors central bankers have been talking about around the globe for the last 12 months is a fiscal response must accompany their monetary stimulus to have an effect. And in cutting rates on the day of the budget, they might let the Treasurer off the hook.
OK, guys.
But the budget will all be written beforehand, so in that sense they won't let them off.
OK, guys, thanks for joining. I could talk about this all night, but everyone probably turn off if I didn't get caught on the market treasurer. But it's a very interesting topic, guys. Thanks for joining us.
Thanks, Peter.
Thanks, Peter.
That's Shane Oliver from AMP Capital and Michael McCarthy from CMC Markets. After the break, another good report for Blackmores today. CEO Christine Holgate will join us to tell us what lies ahead for the company.